Any other questions? This is good.
So what is considered immaterial?
What?
What is considered immaterial? Is it a percentage?
Yeah, that's a great question. That's an excellent question, and it's debated by all the major accounting firms. There's a lot of different ways to determine materiality. You can think about it as a percentage, though, but you have to use judgment. And so, a lot of like a really high level concept, if you have a large company, you might say 5% of sales is material, or 5% of their assets, anything over 5%. But what if a company doesn't have revenue? Like, what if they're a biomedical company that doesn't have revenue? Then it might be like 5% of their loss. Or we choose 5% of whatever we conclude would be material to an investor making a decision. And so, and that 5% could change. You could say 1% or 10%. But ultimately, the determination of materiality is judgment based, where you want to report numbers that matter to investors. So you ask yourself, at what threshold would this matter to an investor or not? And then you would justify your claim. So a good example, like if we can say something's clearly immaterial, if I have a $1 billion business and I spent $1,000 on lunches for the last month. Is an investor going to care? No, I'm like a $1 billion business. Investor doesn't care what I bought for lunch, right? But what if I have a $10,000 business and I spent $1,000 on lunch? That would probably be pretty material. Like you'd be like, hey, what are you doing? Why are you buying so much with for your small business? You know, maybe you need to tighten your budget. You can think about this personally too. We have materiality, right? When I was a college student, when I spent $5 on lunch, that was a lot of money. Like I was like, hey, I don't want to spend $5. That's like maybe 1% of my net worth. You know, maybe I got $500 in the bank. $5 is a big expense. When you're a professional, if you have $100,000 in the bank, you might give away $5, right? It doesn't matter. Like $5 is immaterial. So it really depends on the size of your business and what your investors care about. Right? Does that make sense?
Yeah, it sounds a little complex.
Yeah, everything's complex. Yeah. But that theory makes sense, right? Like it's, hey, what matters to the people? Uh, cool. These are great questions. I'm loving the questions. Okay, so the allowance, let's go to the allowance method. We went over the direct write-off method. That's the easy way. How do we do it the tough way and the right way? So at the end of every period, right? Periods are either monthly or quarterly or yearly. We are going to estimate total bad debts we expect. So now we're going to be talking about, we haven't talked a lot about estimates, but estimates are complex too. How do we estimate something and prove an estimate is reasonable? Well, generally we look at historical records as accountants. We can also look at forward-looking information, but we'd have to look at a combination of historical records and then other evidence like credit scores. So two advantages to the allowance method is we can estimate the amount of bad debt expenses, so we kind of have a metric, and we record accounts receivable on the balance sheet at the amount we expect to collect. So we're not overstating receivables. We know that some of it we're not going to collect. So there's a few different ways we can use the allowance method that are correct. We just have to use a way that is consistent. A, accounting policies always have to be consistent. And then B, it has to accurately depict how the business works. So we have to make an estimate that is reasonable, right? An estimate that actually depicts what's happening. And so here is a high level concept for it. So TechCom has a credit sale of $300,000 the first year of operations. $20,000 at the end of the year remains to be uncollected. And we estimate $1,500 won't be collectible. What do? We debit bad debt expense at the end of the year. We haven't written it off yet. We haven't written off these accounts. We're just estimating. And then we credit an allowance for doubtful accounts. Allowance for doubtful accounts is a contra accounts receivable account. It reduces accounts receivable. So our accounts receivable would be 20,000 minus the 1,500, or 18,500 on our financial statements. We haven't written off this amount. We might still collect it, but we estimate that we're not going to collect it. So this balance sheets presentation. We'd have our accounts receivable less our allowance for doubtful accounts, And our current assets would be that 18,500. Same thing. We do this is just another example of the allowance for doubtful accounts. So once we write off, so once we've determined that this Jay Kent has a bad reputation in this book. I wonder if it's someone who didn't like this guy, Jay Kent, maybe somebody just really didn't like this guy, or he owed someone money who was writing this book. But Jay Kent didn't pay. What we do, instead of writing off the receivable directly, we write off the allowance for doubtful accounts. We adjust it. So we credit, so instead of us, originally we do credit this and then debit the bad debt expense directly. The bad debt expense was already debited when we did the allowance for doubtful accounts. So now we just credit the accounts receivable and debit the allowance for doubtful accounts. Note that the write-off doesn't affect the realizable value of the accounts receivable, right? The 18,500 stays the same. All we did was move the allowance. So we wrote off some of the account and then we moved the allowance amount. That's how contra accounts work. They try for us to try to make a reasonable estimate. And then what happens if Jay Kent pays us back? Well, we have to reestablish the allowance for doubtful accounts. This is what makes it more complex, right? When we did the direct write-off method, we just reversed the entry. But now we have to flip two entries, right? We have to get the accounts receivable back. Then we also have to get the allowance for doubtful accounts back. And we have to get the cash back, debit the cash, and then credit the accounts receivable. So another way you could do this is just debit the cash and credit the accounts receivable, because these wash, the accounts receivable wash. I mean, debit the cash, credit the allowance. But I'd recommend at this stage that you do both journal entries. And you'll have to memorize all these journal entries. So this is the big difference, right? We're not just doing a flip, that now we have to always establish the allowance. Theoretically, why are we reestablishing the allowance for doubtful accounts? That allowance for doubtful accounts is going up because it's a credit balance, right? It's a contra asset. The reason that we're doing that is because we collected this. So in theory, our estimate needs to still be that we're going to not collect $1,500. So we reestablish it because we assume another customer won't pay. And then we'll change that estimate quarterly based on our new information. So let's go through this question. The retailer applies the allowance method in accounting for uncollectible accounts. What do? The retailer estimates $3,000 of its accounts receivable are uncollectible. So day one, on this estimated day, we do $3,000 bad debt expense. Expenses have a debit normal balance. It'd go on the income statement, reduce our income. And then allowance for doubtful accounts, which is a contra asset, contra accounts receivable, would be credited $3,000 and reduce our accounts receivable. Then we determine $400 needs to be written off for ZZZ company. So we debit our allowance for doubtful accounts and then credit our accounts receivable. We're writing that off directly to that customer so we don't bother them anymore. And then we've adjusted our allowance for doubtful accounts. We don't hit bad debt expense at this time because we already hit it in December. We already estimated. And then at the same accounts receivable, then ZZ company on April 1st, they come back and say, hey, we're actually going to pay you. We messed up. We want your product. We then debit our accounts receivable, credit our allowance for doubtful accounts. So we reverse this entry so we can reestablish the allowance for doubtful accounts. And then we debit cash and credit accounts receivable for $400, which this would just be the original entry if we did none of the above, right? If they just paid on time. So we know all these entries, just know the flow. Right? None of these are really new entries other than this first one, the bad debt expense and allowance for doubtful accounts. Just understand the flow, that we reverse them. Ultimately, we're trying to collect cash on the accounts receivable.